We're happy to be here. As John said, Chris and I are the two attorneys here at AAF. I've been here for just over 10 years, and this is my 10th appearance at the AAF nonprofit annual seminar. So I'm excited to be here. As John said, we're talking today about taxes for the tax exempt. And so, hopefully some of these actually may be an opportunity for the tax exempt organizations out there to get some money from the government, which would be a nice change. So today I'm going to be talking about the IRS accomplishments for 2022, their objectives for 2023, a little bit about the Employee Retention Credit, and then Chris is going to finish up with the Inflation Reduction Act. So the IRS has been very excited about their new staffing with the Inflation Reduction Act that the Biden administration was able to get passed earlier this last year. They got approximately $80 billion of funding over the next 5 years, which is really going to allow them to significantly increase their staffing. That has been one of the techniques that the Republicans has been using traditionally, was to underfund the IRS and therefore potentially limit the ability for them to effectively audit the more complex returns. The IRS is one of the most understaffed federal agencies out there, with approximately 80,000 staff in general. But that we hopefully will be seeing changing. They've also been having significant turnover recently, with a lot of their more experienced staff getting ready to retire. So here you can see for the nonprofit exempt organization group at the IRS, they started off with 1,521 staff. They lost 187 employees, hired 183. Of those 183 that they hired, 126 are revenue agents. There's 6 compliance officers, 13 tax examiners, 11 analysts, and 27 other. That other is really computer staffing, as well as data analytics, which the IRS is really turning to in order to determine who they should be auditing. It was interesting. I just spoke on Tuesday with Janet Wu here in Boston about IRS audits and the fact that the African Americans have been more highly audited than any other group out there. And so that's an interesting study that just came out that I would encourage you to take a look at. And apparently it significantly relates to the earned income credit, that the IRS has been auditing the earned income credit very heavily because they see it as an easy avenue of audit with very little opportunities for people to argue. So that's one areas that the IRS has been looking at. On the nonprofit side, in 2022, they completed 3,425 examinations. And think about it, that's out of the millions of nonprofit organizations out there. So, there's not a lot of audit activity going on in comparison. There's less than a 0.01% chance of being audited in any given year. Of those audits that they did complete, 78% did result in some sort of tax change. Typically, those are on the question of whether someone's a 1099 or a W-2 employee. That's a topic that the IRS really likes to examine with the nonprofit organizations. But there were 53 tax-exempt organizations that lost their nonprofit status as a result of their audits. One of the key activities of the nonprofit group at the IRS is obviously to review the 1023 and 1024 nonprofit applications that are being filed regularly with the IRS. In 2022, they closed over 136,000 of those applications. 119,000 being approved, and of those 119, or almost 120,000, 113,000 were 501c3 nonprofit applications. So just think about it, with the small staff that they have of 1,500 people, they were able to review 136,000 applications. And those applications are not simple. They're, as you know, they're multiple pages, easily being up to 60 to 100 pages long when you consider all the attachments that have to go into them. So they're very complex, and it's impressive that they were able to review that many applications. Of course, they have gone to an online application, so perhaps that might be something that has assisted them with that process. So the IRS goals for 2023, they're looking at the regulations for group exemption letters. Right now, such organizations as the Boy Scouts or other national organizations, they have a single exemption letter for all of the activities throughout the country. And you can just you can apply to plug into that group exemption letter. The IRS is not thrilled with that model and is going to be looking at revamping it significantly. They're also looking at the donor advised funds regulations. A lot of organizations are using donor advised funds to get around the public support test by having individuals or groups that might otherwise be non-countable for the public support trust to apply to make a contribution through their donor advised fund, and so therefore it's counts towards the public support test. And so the IRS is on to that, seeing that as a way of circumventing that public support test. They're also considering having required distributions from donor advised funds on an annual basis, similar to a private foundation that requires approximately 5% of their assets to be distributed on an annual basis. Right now, a donor advised fund has no required distributions. The money can just sit there and grow and grow and grow without ever being distributed to a charity, despite the fact that the money going into that donor advised fund received a charitable contribution. So the IRS is looking at that and considering requiring distributions. They're also looking at regulations on supporting organizations. They issued proposed regulations back in 2009. It's a very complex set of regulations. We're not going to go into detail that here. Suffice it to say that if you are a supporting organization, you should be talking to us about those 2009 regulations that they're looking to finalize this year. You also may recall that in regards to the unrelated business income tax, the Congress passed laws a few years ago requiring the siloing of all activities, so that any unrelated business income tax activity, you could only deduct the expenses for that particular activity against that particular activity's income, and you couldn't spread deductions across all of the activities. So they're going to be issuing regulations regarding that. And finally, for the private foundations out there, they're looking at the rules regarding investing in partnerships in which disqualified individuals are also partners. They don't want to have the nonprofit foundations, the private foundations, supporting partnerships for their donors. So they're looking at that very closely as well. Moving on. As I said, they're looking at the donor advised funds. There's a possible 20% excise tax on sponsoring organizations for distributions to individuals. So a donor advised fund can't make a distribution to an individual. It can only make that distribution to 501c3 organizations. And so they're also talking about 125% excise tax on distributions that may cause an incidental benefit to the donor, and 25% tax on the individual that received the benefit. So what that tells you is, again, donor advised funds should only be making contributions to 501c3 organizations. The IRS has also been very strict lately in terms of allowing charitable contribution deductions. We've noted 2 cases here where significant charitable contributions were disallowed because the individual did not check all the boxes on their personal return. They either did not receive an acknowledgement, a timely acknowledgement from the organization, or they did not specify whether or not any value was received by the taxpayer. Both requirements that the charity must meet when they receive a charitable contribution. And finally, I'd be remiss if I didn't mention the employee retention credit. The ERC is a very valuable credit out there. I know I get emails and texts on a daily basis from these consultants who are out there telling me how much money I can get back from it. I would caution our clients and nonprofit organizations out there to not just go with these fly-by-night consultants. They'll come out there and they'll meet with you and they'll tell you that you're going to get millions of dollars in this employee retention credit back. They'll take their fee and then they'll disappear. And a few years later, the IRS will finally get around to auditing you, and you'll find that what they've claimed you were eligible for, you may not necessarily have been. I would strongly encourage you to work with our task force on that. My partner, Courtney McFarland, very knowledgeable on this subject, and she would be very helpful to make sure that you get the retention credit that you're entitled to. So now Chris is going to go on to talk about the Inflation Reduction Act that just passed here in 2022.
Thanks, Josh. So as John mentioned, my name is Chris Consoletti. I'm a tax consulting attorney here at AAFCPAs, and I will be talking about the Inflation Reduction Act, which was passed into law by President Biden on August 2022. But before that, we will set our first poll out. And our poll question is, has your tax-exempt organization installed any clean energy property? So just an overview of what I'm going to talk about for my portion of the seminar, I'm going to explain how there's been a change for tax-exempt organizations where they can receive direct payments of credits from the Inflation Reduction Act in lieu of just a credit on their taxes owed, which often they don't owe any. I'm going to talk about which organizations are eligible to receive these direct payments, which credits from the Inflation Reduction Act are eligible for their direct payments, and then I'll wrap everything up with what do we know now, what do we advise, and how can AAF help your organizations? So just very generally, the Inflation Reduction Act, what it does is it extends, codifies, and it creates many energy-related tax credits. So in the past, for your tax-exempt organizations, absent filing a 990T, tax-exempt organizations would have little use for these credits unless they either owed tax on related business income or they constructed the eligible clean energy property themselves, which often is not the case. So in response to this, the Inflation Reduction Act, which I'll just refer to as the Act going forward, what it does is it allows certain non-taxable entities to receive the credits as a direct payment to them, a check issued to them, as opposed to just a credit on their taxes they may or may not be able to use. This is effective for tax years beginning after December 31st, 2022. Okay. So which organizations are allowed to receive these tax credits? So tax-exempt organizations, but not just 501c3s, but also C4s, C6s, and what's particularly important in Massachusetts is state and political subdivisions. So that would include charter schools. They would be also eligible to receive these direct payments as credits. So which credits from the Inflation Reduction Act are actually eligible for these direct payments? The slide before you is a list of all the credits that are eligible for direct payments, but what's probably most relevant to your tax-exempt organizations are the production tax credit as well as the investment tax credit. So it's important to note that you don't get to take both of these. It's basically one or the other. So just generally, the production tax credit, it's a per kilowatt hour tax credit for clean energy generated by your clean energy property for the first 10 years that the project is in place. Whereas the investment tax credit is an up to 30% credit on the investment in the clean energy property. So the production tax credit will pay you out over 10 years, where the investment tax credit is an upfront up to 30% credit. So what do we know now with the Inflation Reduction Act, the direct payment program, and how do we advise and how can we help you? So as I said before, the most relevant credit and the one that I get the most questions on is the investment tax credit. The investment tax credit, it applies when certain eligible energy property is placed into service. That eligible property consists of anything including solar panels, wind turbines, hydroelectrical projects, and other renewable and clean energy products. So it's when they're placed into service, that's when the credit could apply. So how much could this direct payment be? As I did mention before, it's up to 30% of the cost of the eligible clean energy property, but it's up to 30%. So it's important to note that it starts at 6%. The credit is 6%. It goes up to 30% if certain criteria are met. Criteria being prevailing wages are paid to employees. Are there enough registered apprenticeship requirements? Things that we at AAF can help advise to make sure you can get the credit up to 30%. And it's important to note that this expanded credit, the investment tax credit, it's set to sunset or go away by December 31st, 2034, absent some congressional extension of the credit. Okay. So how would this direct payment be made, as it's new? Tax-exempt organizations have not in the past received direct payments. It's always been either a credit or something they couldn't use. So surprisingly, the IRS has not told us. We don't know how the direct payment is going to be made, but what we at AAF and we theorize is that could be very similar to how the direct payment in Massachusetts is made for the CITC credit. So just an overview, if you're aware of it, the CITC credit in Massachusetts applies when a organization makes a qualified investment in eligible property, and then they receive a credit, say $30,000, $20,000. How they claim this credit, they receive a certificate from the state. It has a certificate number. What they do is they file their Mass 990T. So this applies for tax-exempt organizations. If they owe unrelated business income, the credit is offset by that tax. They receive the difference refunded to them as a direct payment. If they don't owe anything, they file a blank 990T. They claim the entire amount of the credit, say $30,000. It says $30,000 refunded on the Mass 990T. They get a check back for $30,000. So that's how it works in Massachusetts. The CITC credit would be very similar to the investment tax credit to the IRS. In Massachusetts, to claim the credit, what they do is they issue a certificate. You have a number. You add the number to the Mass 990T, get the money back. That's how you get the direct payment. So the IRS, as usual, has issued requests for comments. They've put out a notice asking for comments by exempt organizations about this direct payment, but they have not actually outlined any clear guidelines. Not surprising, they're not very fast. What the IRS has said, they have made this clear, is that any direct payment under these credits, what it does is it first applies against the organization's unrelated business income tax, if they owe any, and then against any penalties or interest owed. So that's important to note once we finally have final guidelines on this, that if the IRS has issued any penalties, notice, or interest because of back 990s, late 990s, you want to make sure that you clear those penalties up before you apply for any of these credits, because the IRS system is going to automatically take the payment and offset it by the penalties. Even if you don't know the penalties, even if you had already filed for an abatement, it doesn't matter. They're just going to do it in their system. You're going to get a payment back minus the penalties. So it's something to be aware of before you do anything. It's something we can certainly help with. As I mentioned before, we don't know how exactly exempt organizations will claim this direct payment, but we know that in the past, there's some precedent for making an organization file a blank 990T to claim payment made. If you remember back a few years with the parking tax fiasco, we had to file 990Ts to get the money back. So there's some precedent to having to file that to get the payment back. This also would prevent the IRS from having to create new forms, new procedures. So it would be a quicker way for them to have organizations get this money back. So it's certainly possible, but again, we don't know how the payments will be made. So what are the open-ended issues for the Inflation Reduction Act and these direct payments, which are new? What we know is that the exempt organizations need to make an election for the credit no later than the due date for their taxable year is due, which makes sense. What we don't know is the organizations who don't have to file a 990, when do they need to make the election? When do they need to, how do they make the election if they're not filing a 990? So this would apply to charter schools in Massachusetts who don't file 990s. There's also been no guidance as how the applicable credits will be substantiated. How will we prove that we're eligible for, say, the investment tax credit? In Massachusetts, they issue a certificate with a number, but we don't know how it will be handled federally. We also don't know if, say, a tax-exempt organization works with a for-profit and a joint venture, will they be prevented from getting this direct payment because they work with a for-profit, or will they still be allowed to? We also don't know if the direct payment, how it will be characterized on the 990. Will it be listed at all? We have to list it on the assets. So there's no guidance there as well. So just wrapping it up, what do we know? How can we help you? Basically, AF, me, Josh, the whole team here, we will stay up to date with the changing tax laws and procedures on this and issue guidance when we know it. We can also help you determine if you have eligible property that may entitle you to a credit or direct payment. And we can proactively analyze and help you plan future projects that might qualify for any direct payments. We can help you if you are thinking about installing clean energy on your buildings. We can help you come up with ways to make sure you get the full 30% of the credit. So that having been said, we have about a minute for any questions, if there are any.
Great, thanks, Chris. So we have received some questions. I would remind you that there will be a breakout session later on this afternoon where Chris and I will be able to discuss all of these issues. Just a few of them here. Can nonprofits take advantage of the employee retention credit if they're a professional employer organization? I would say, I'm afraid I don't have the answer to that off the top of my head, but it doesn't hurt to talk to Courtney about that. She would definitely have the answer to that. Chris, for tax credits
Sure.
installed in 2020, I don't think you'd be able to get the investment tax credit, but what about the production tax credit?
You would be able to get it, but like I said, the Inflation Reduction Act was put in 2022, so that a lot of these rules I'm speaking of are in place now. So there would be no direct payment for the production tax credit, but it's still possible that you could get a credit on your 990T, or maybe even sell it. I know there's other ways to do it.
And then the question in regards to a federal grant, I don't think we have is this credit allowable if the clean energy equipment was funded through a federal grant? I'm not sure whether you'd be able to double dip on that. That's a good question. That's something we could definitely look into for you. But again, I would remind you that we will be available for the breakout room later this afternoon. With that, I guess we'll be handing it back over to John to introduce our next panelist.